Please stay tuned after the conclusion of the podcast for additional important information. Hey everybody, welcome to another episode of Accrued Interest, PIMCO's podcast dedicated to serving financial advisors and their clients. I'm your host, Greg Hall, as always, and I have with me today another Greg Sharenow, who you may remember from last year. We had Greg on. Greg heads our commodity and real asset investment area here at PIMCO, and we had him on to discuss, amongst other things, gold in that run-up last year. And today we're going to talk about the energy complex and some of the long-term structural forces influencing energy around the globe. But we might find our way into a few other areas of commodities. Greg, thanks for taking the time away from the desk to be with us and to speak to the folks who listen to us.
Thanks for inviting me. I always love our time together here, Greg.
Yeah, no, and I know it's volatile, notwithstanding the MOU that's now in place between Iran and the U.S. You know, markets are still moving, and I know the headlines, change by the minute, and so you're glued to your desk, to your screen, trying to stay on top of things. So in that context, it's all the more appreciated that you would you take a half hour here to speak to us. Maybe we start there, Greg, if that's all right. I think that's what's on most advisors' minds right now, which is, how do we interpret the MOU? What do we think the implications are in the near term for the normalization of oil traffic through the Straits of Hormuz. And then maybe we'll get into some longer term impacts of what this is going to mean 3, 5, 10 years down the road, for energy traffic and energy trade.
Yeah, so I think it's a great question, a great place to start, because we are talking about the largest energy producing region, and not just energy. Big export of aluminum, big exporter of helium. There's a variety of fertilizers. Like, this is a very important topic to discuss, in part because of the relevance to the global supply chain. When I look at where we are today, I describe it best as we are at the beginning of the end of this phase. Right? We are in a point where there's a MOU in place that is focused primarily initially on normalizing oil flows and energy flows out of the Strait of Hormuz. Now, a 60-day window by itself is not enough time to normalize. Mm-hmm. Even if you just talk about repositioning the global tanker fleet, it's going to take 60 days. And that's if everything goes smoothly. Restarting production, we're probably going to be able to get 75, 80% restarted in that period of time. But as we saw with Qatar Energy, as recently as 2 days ago, where a massive explosion unfortunately claimed the lives of 13 employees in Qatar, wasn't a LNG-focused problem. It was actually a gas plant that served the domestic market. You could see it highlights some of the challenges in restarting and getting all the production back onto normal. And if that had happened to an LNG train instead of a domestic train, you would have seen a meaningful rally in global gas prices. So we are really susceptible to how this unfolds. So why is this the beginning of the end of this phase? Is that the next phase is what happens at the negotiating tables. And the negotiating table is one that would be challenged. If historical precedent shows that JCPOA, as another moment in time, took 2 years to negotiate. We have a lot we're trying to accomplish in 60 days. With extensions, we'll probably be able to punt this back past the midterms, but the challenges in getting to an agreement are always going to be very hard. Mm-hmm. There's a lot of economic inducements on the table right now to try to help facilitate it, but until we get to the end of this phase, it's hard to know exactly how much supply. So one would have to assume there's still non-trivial chance that we have supply disruptions, and there's incentives for spoilers to try to make this less easy to accomplish. So in my mind, it's great to see energy supplies normalizing. Exactly how fast will be a function of how long and how dependable the straits are open for, so that everyone can begin moving in the same direction and re-engaging all their employees and so forth to get the strait and all the energy supplies reopened. But there's many, many challenges in the road ahead.
Is the backdrop to this, because you mentioned the gas explosion in Qatar and just the tension in markets is the backdrop that inventories have been drawn down to a level where we just can't absorb, dislocation without just much more price volatility than you would typically expect to see. Am I interpreting that correctly?
Right. So whenever you're at really low inventories or really high, your system has a lot less flexibility.
Right.
So marginal changes have an exaggerated impact. Right now, we are at very low inventories. We've had some of the sharpest draws we've seen in history in inventories in the United States over the last 2 months. If you look at the global supply chain, it is running very thin. So any hiccups will lead to price volatility and price spikes. I was surprised, to be honest, that President Trump mentioned that we were 3 to 4 weeks away from critical problems in the energy supply as a reason to be excited about this MOU, which is truth. I'm not disagreeing with it.
Yeah.
But it makes me wonder just how much the managing the global economy and managing global supply chain came to the forefront. And then it tells you, if you want to be a spoiler, how conceptually easy it is to find that pressure point when you're at a level where the inventories are so tight and your flexibility is so limited. Right.
Well, and look, I think you're pointing out the fact that we'll all still be glued to the headlines and watching the developments of the ongoing talks with a lot of interest. It's not on autopilot.
Correct. But it's better than bombs dropping on a daily basis and threats of additional bombs. Like, hopefully for the global markets, we can focus on a lot of other topics, understanding how the corporate earnings are coming in, what the economic momentum, like the stuff that we as economists and portfolio managers can have a more sane conversation about. And I say sane in the standpoint that we're talking about 15 to 20% of global energy supply. It's not like we're talking about, half of 1%, which is what I, historically would be quibbling over.
Well, yeah, no, I mean, that's an interesting, just in context, right? I think I've heard you say, and I have every reason to believe you're exactly right, that the portion of the energy market that's been disrupted over the last few months is unprecedented in its magnitude. I mean, give people listening a sense of just the impact of what's happened, because we've all lived through it. But I think that your historical perspective, and as you and I have talked over the last couple of months, I've seen how concerned you've been at times that maybe things wouldn't end up in the right place for long-term energy market stability, and what that could have meant given the risks in that part of the world.
Yeah, so for, I think, contextual color, in COVID, when everyone got locked down, for a quarter, we lost about 8 to 9% of global demand. Mm-hmm. Right? At its peak was a little bit more, but, call it sub 10%. We, at our peak here, had lost about 15 to 17% of global oil supplies. Like, the magnitude of adjustment, if you really had to think that through, if this sustained, if we didn't have the SPRs because we drew them down, if there wasn't any flexibility left in the system, would have been very challenging to figure out how do you take that demand out. And when you look at, frankly, a lot of the demand numbers that have come in, jet fuel demand globally has stayed pretty resilient. Mm-hmm. Gasoline demand in Europe still expanding. Diesel definitely took a hit. But when I start looking around the world, yes, we definitely lost demand, particularly in lower income countries. I don't think that as lost demand is never coming back, but certainly if you didn't take your train trip or plane trip, or, that you don't get a chance to do that again right away. But the point being is that we still had a pretty resilient global economy despite, and it would have been challenging in that backdrop to see how you cut out that much demand if this went on another couple months. So we're in a much better position for the global economy right now to have oil supplies normalizing, even if it's not back to 100%, 70, 80%, gives you enough leeway and runway here to see if we can get to that 60, if we can get past that 60-day period and actually have more stability and more peace or not.
When Dan Iveson, our group CIO, for those listening, he was on with us a couple of weeks ago, and we obviously didn't know the MOU was coming, but we did talk about sort of the way he was in his own mind, parsing out the scenarios around the Iran conflict. And, the base case, as he described it, was a steady reduction in hostilities over time, leading to a normalization of oil prices. The left tail case, the worst case outcome, was clearly a resumption of open hostilities and much deeper, more sustained damage to energy infrastructure. And then there was, depending on how you look at it, you call it a right tail case, maybe from a financial markets perspective, putting aside any political objectives somebody might assign to the conflict. Where you have a quick and easy resolution. Either side is sort of willing to give in to the other on a unilateral basis, and then you move on. It sounds like we're pretty firmly in that base case still, despite the MOU. Is that your interpretation?
Yeah, I think we're in the base case right now, romancing the right tail for the global economy, and with less energy prices, without any certainty that we're going to move sustainably to the right tail. So I think there's still, if you're putting probabilities, the right tail has gotten larger at the expense of the left tail, but the base case hasn't dramatically changed.
Can we talk a little bit then about what in your mind has changed about the global energy system because of this conflict? And you pick anywhere you want to go, and I'll ask a few questions along the way, because I'm sure there's no shortage of topics to look at here.
Yeah, I think there's a couple things that are really, without a doubt, going to be a driving force after this. This is the third major supply shock this decade, right? Bounce back from COVID, Russian invasion, and now this year. So security of supply, whether that is more nuclear, more oil and gas drilling, more renewables, which if you start looking back over the last 10 years, it's actually been the opposite of what you would expect. Like a Republican president has maybe less hospitable to renewables than a Democrat, and yet renewables performed horribly under Biden administration to investors, and under Trump actually was much better. So there's a fit of irony of this all, is that we're going to see all energy higher and more invested, and it's going to be security of supply and marginal safety, so more storage holding around the world. So
kind of all of the above on energy production, with an emphasis on what can I do in my country so that I'm not, my access to energy is not subject to the decisions of another world leader.
Correct. I think the resiliency is absolutely important. And when other governments look at like how China's managed to navigate this, large petroleum reserves, we're able to pull on those inventories, they've already bent the curve on transportation fuels on road, where they've seen a decline for the last 4 or 5 years between diesel and gasoline has been on a trajectory. Their electrification has been a lot higher. So in many respects, if you just take an example of a country that has done particularly well, who wasn't resource rich, right? Like the United States is an energy exporter and was able to, like, on net, even though consumers didn't get the benefits by itself, but the economy did. China is an example of a massive energy importer who managed to, push its way through in a relatively strong position. And I think a lot of other countries are going to try to look at that as a model and say, well, we want inventories. We want security of supply. Now, you have to have the capital to do the inventories, by the way. It's not like, poof, we just hold oil.
Right.
There's money that has to go to it. And a lot of countries may not have the money, but those who do are going to be really reevaluating. Companies are going to be evaluating. And I think that does mean bigger supply chain resiliency closer to home.
Yeah, so China managed its energy portfolio adroitly, through this crisis. The U.S., obviously, the shift to being a net exporter helped us at the national level. Gas prices painful to people, for whom the marginal dollar really, means a lot, but overall. And then you've got, obviously other parts of the world, and we've talked about this in the context of rates, right? Where we do feel like higher energy prices, could result in slower economic growth. Some of the developed economies that, are net energy importers. Dan mentioned that on the last discussion as well. What about in the region, Greg? When this is. I'm embarrassed if this is overly naive, but it strikes me that if the Straits of Hormuz are such a dangerous place to take oil through, as cheap and efficient as that might be, relative to other options, are we not building pipelines across deserts to make sure that doesn't become such a leverage point in the future?
There's no doubt that there's going to be more efforts made at bypass. The
Right.
problem is, if you put more into the Red Sea, you still have two pinch points in the north and the south, whether it be the Suez Canal or whether it be the area that goes around Yemen. If you go to Ceyhan in Turkey right now, where there is a number of oil from Iraq flows through, you're not any closer to China and Asia, where your big consumers are. So, there will be, UAE has been very clear on their expectations to expand pipelines to the Gulf of Oman so they can avoid the strait. But it's still a fairly challenging environment, particularly if you're a Qatar, for example, talking about a country we already mentioned, or Bahrain. Where are you going with your energy supplies? You're going to have to traverse someone else's property. And for the value chain of Qatar, which exports a lot of LNG, you would lose that upgrading value.
Yeah.
So there's going to be attempts to make it less dependent on the strait, and sort of as a result, any one country's influence over the global energy market should decline with that. But as we have seen in wars, stationary objects can get hit just as well as a ship. Pipelines can get hit across the whole region.
Right.
And, that was whether it be in the Gulf of Oman, whether it be on the western side of Saudi Arabia, whether it be anywhere else in the region. So it's not a panacea itself, but certainly from an investment standpoint, when you look at PIMCO and looking at opportunities in the region, I expect infrastructure to be an area where there's going to be increasing amount of capital deployed over time, and not just there, but not just in that region, but everywhere.
The UAE withdrawing from OPEC amidst all of everything else that's been going on. What do you think of the long-term consequence? Do you attribute that to the conflict? Was that opportunistic on their part? And then two, what do you think the downstream consequences of that are for the energy market?
I think it was very opportunistic. I think the tensions between UAE and OPEC, namely the big kahuna in OPEC, Saudi, over allocations and what they can produce, I think has been a simmering tension. And UAE has really been highly focused, as well as Saudi and other countries, on all energy supplies need to be developed. So I think from them, they've been traveling a different path for a while. And I think separating from OPEC today was in their interest, or was a chance for them to take something that they believe is in their interest. I think on the long term, they're talking, it's hard to know exactly what operable capacity they have. They claim north of 4 million barrels a day versus what they were at 3-4. So let's just say it's half of that they can be deployed. It's 300,000 barrels a day of oil. That's 0.3% of global supplies. Not trivial on the margin, but at the same token, it's not going to massively change the global balance. It's just like Venezuela is not going to massively change the global balances in the next few years. But I think from their standpoint, they made a lot of investments. They brought a lot of international companies into their supply chain across all the energy supplies. I think they want to be able to use it. So from that standpoint, it is marginally depressing prices on the medium term if they're willing to deploy and produce it.
Okay. Of course, all of this is not happening against a sort of a neutral backdrop of energy demand. We talked about this the last time you were on the podcast, but it was we didn't dwell on it. So I'd love to go a little bit deeper. The AI boom, the data center construction boom, the need for compute and to power more and more chips doing all of the training and inference, for us in the AI space that's a trend that appears to be alive and well. And so you place that demand increase next to, some of the other trends we've been discussing here on the supply side. And how do you think that influences your outlook for the energy complex or commodities generally over the next 5 or 10 years?
Well, I think AI is one of the 3 major CapEx cycles that are going to happen. that are incredibly commodity intensive, not just energy, but raw materials. You have the military industrial CapEx cycle, you have the AI cycle, and you have the energy transition cycle, right? Of which now the challenges on the energy transition is higher because baseline power generation load or demand forecasts are meaningfully higher than they were 3 or 5 years ago, even 2 years ago.
Yeah.
So the amount of infrastructure that needs to get built, the amount of green infrastructure, particularly if you want to have more supply chain resiliency onshore, right? If you can produce more oil and gas to supply your power grid, you're really down to renewables where possible, plus batteries. I think all of these things are going to end up having a pretty high CapEx growth, of which commodities are distinct beneficiaries. Now, once you're done with all the investment cycles, you can see that having a negative impact on marginal energy prices if we end up having a surplus of renewables, if we end up having a lot of battery build out, more nuclear. But we're not talking 2 or 3 years this happening. If you look at the outcrop of the 70s, this really was a decade plus long process. And it's much harder to build nuclear these days than it was then. And that was probably the biggest thing that chipped away at oil demand because it pushed it out of the power pool. So when I take a step back and I say, okay, yes, we definitely have a real CapEx demand cycle that we haven't really had supporting commodities pretty much since the ascension of China into the WTO, and then how China's demand basically dragged up global commodities from 2000 until the global financial crisis.
Tell me more about the 70s. What's the analogy you're looking at there? I love it when we can bring in a little bit more of a historical context into, especially the commodities market that moves in such long cycle waves, right? It's been so volatile of late. We tend to forget that production takes a long time to build and takes a long time to destroy. And so, you tend to think in 10, 20, 30-year timeframes in a way that I think not all of us naturally do.
Yeah, so I think the point that I always take away from the 70s is it wasn't one shock that did it. It really had two major energy shocks, basically buttressing the 70s. And, early 70s with the Arab OPEC embargo that led to not a massive shortfall of global supplies, but what the world discovered is that in Texas, where the Texas Railroad Commission had acted like OPEC, with constraining supply, found out there was nothing left to be constrained. We had actually underinvested. Then you get back, and then you have the Iranian Revolution, the Iran-Iraq War, and we ended up having a second real big supply concern. And that led to a meaningful investment cycle, bringing more nuclear forward. We had more coal plants being built. We had a lot of different energy. The difference, though, I think today versus then, is that I think it's much harder to build in many places around the world. The NIMBYism is a real opposing force. Germany was just recently shutting down their nuclear plants. The tide in many places is going the wrong way, not even in the right direction. And if you look at AI, one of the big questions is, where do you get your power from? Do you have to put it behind the gates and generate your power yourself? These are real challenging issues that I would love to say, and we've been now talking about permitting reform in the United States for a decade?
Sure, yeah.
And we've made very little progress. So places like China, who has the ability to build, has really seen an outpacing of the rest of the world in the energy evolution, while U.S., Europe, and some of these older established economies are struggling to keep pace. So I think we need to build it all. I think we're going to have challenges building it all, which means I think we're going to have a hard time supplying all the energy that is needed to fulfill the AI and boom and cycle that's coming.
Right. Bullish for power pricing, bullish near term. For commodity demand, how much of that do you think is sort of priced into the complex? At this point, how well appreciated is that demand curve right now?
I think it's highly focused in the metal space, for example.
Okay.
In the sense that there's a lot of attention to the growth trends because metals in particular have a problem, which is the CapEx reinvestment is per free cash flow is at 40-year lows. There's just not a lot of CapEx. The pipeline is really thin. Even small marginal changes of late is still like a drop in the bucket relative to the expected CapEx cycle. So there's a market where it's a lot of attention, But if we have some economic growth and stability and it could really assert itself, that's an area where you could see even more attention given to the demand cycles and the challenges in supply. In terms of the energy markets, U.S. gas has the benefit of growing LNG exports, but we've also have the benefits of relatively cheap natural gas that continues to be brought to the market year after year after year. So, there's not a massive premium out there, but if we ever run into a situation where the incremental growth is challenged, the U.S. is still massively discounted to the rest of the world and could see some price appreciation. In terms of the globe and oil specifically, there's a lot of competing forces in the sense that, how many energy shocks do you want to have without changing your long-term trajectory in oil demand, like China did it. Electric vehicles are penetrating around the world and growing. Mm-hmm. And I think that also has been impacting diesel. So you do have a growth in alternate energy supplies that yet another shock is certainly helpful for. But at the end of the day, global oil demand still continues to grow. Not right this moment in the middle of this energy environment, but we still are growing every year, just at a slower rate. So given that as a backdrop, we need prices to continue to incentivize investments in order to meet that future growth. So it's not a dire scenario, even if we're at a slower growth trajectory. We haven't fully bent the arc down. I think I was looking recently at an IEA forecast where only 2 years ago, 2025 demand came in higher than their 2030 demand forecast. We're just continuing to exceed expectations. On global demand.
And it's interesting to hear you say it's not the failure of renewables to come online, because they have been, and maybe less so on the margin in the U.S., but electronic vehicle conversion in the rest of the world is continued to be healthy. It's just, I think it's a product of economic growth around the world, and
Absolutely.
and hopefully a dynamic, robust economy helping people out of lower levels of income into higher levels of income. I would imagine they become bigger energy consumers.
Yeah, and before this war, jet fuel demand was chugging along every year, grow outside of obviously controlling for the recovery from COVID. There's some meaningful growth. I've been shocked with how strong jet travel and jet demand has been this last couple months, and is expected to be this summer. I would have thought a much bigger backup would have happened than ended up happening.
Yeah, well, I mean, we did talk about that in our economic outlook piece that we published a few weeks ago. Just the prospect for demand destruction elsewhere in the economy if gas prices stay too high, you drive your car less, you go to fewer restaurants, that's been a predictable outcome of shocks like this. Doesn't seem like we've seen evidence of that yet. What do you think is the prospect for seeing lagged evidence of that we just haven't seen the numbers at this point? Or did we just never get quite high enough in energy prices to kind of create those impacts?
So I think in the U.S., we've definitely saw some drag in gasoline demand. We saw some small declines in jet. But these things are on the order of magnitude that are pretty small compared to the oil balance shock that we were having. I would have expected meaningfully higher. I think a lot of what you said about we didn't experience the worst of prices that could have happened or could still yet happen, but obviously it's not the baseline anymore. I think you would have had to see bigger losses than was imposed. I think the government refunds certainly help fatten wallets at just the right time.
Sure.
The timing there was about as good as you could have gotten. So I think that helped keep the demand going. And the fact that, if you look at the last couple of employment reports, we're adding jobs, we're not losing jobs. There's still economic momentum that is evident, and not just a phenomenon in the stock market, but in real data as well. So I think that what it comes down to is that even though you had high prices and you had some discretionary changes on the margin, you didn't have an economic problem that was too, overwhelmed from the energy shock or something else that really overwhelmed demand and drove it lower.
Yeah, it's I keep referencing other podcasts. Sorry, Greg, I going down my own little trip of memory lane, but we did have Libby and Rich on, and Libby had mentioned the tax refunds, which were meant to be a nice dividend, a nice benefit of the One Big Beautiful Bill Act. And I guess depending on your perspective, they either came at exactly the right time and they offset higher gas prices for folks, or they came at exactly the wrong time and they were completely lost as a political weapon in the backdrop of the conflict with Iran. But either way, kind of netted economically for a lot of people.
One of the things I like by referencing prior podcasts, as long as you also point out the things I've made wrong and keep me honest, then I like it a lot, even more,
Yeah. No, we do try to do that. I go through transcripts before we do these and try to keep us and keep people who join us honest about prior claims. And one of the things, actually, speaking of which, you and I talked about the last time you were on, and I think this is it's a pretty confusing picture, actually, if you look at the last couple of months. So we talked about gold when we were on last. We talked about its inflation hedging properties and the way that central banks around the world have moved their reserves in that direction. And but if you look at gold, if you look at Bitcoin, another commodity, little c commodity, that people point to as a store of value or an inflation hedge, you wouldn't, amidst all the inflation scares that we've encountered over the last few months, you wouldn't immediately look at their price charts and say, aha, people think of those as inflation hedges. So what do you think is going on in the price action of maybe gold in particular, but feel free to venture a viewpoint on Bitcoin as well.
If you look at 2022, gold did the same thing. It anticipated problems way better than it performed during. And, a colleague here said that gold is what you own when you're afraid of something. Gold is what you sell when that thing is happening.
Right.
And in many respects, it's exhibited again this year. But also, gold's had a really rough year. It's down 9% after, 67% last year. This decade, it's up 15.5% per year.
Yeah.
I mean, these are pretty meaningful returns in an inflationary environment where gold did actually perform pretty well. I think there was a little bit of exuberance over the fourth quarter and into the start of the year. They really sort of elevated those values and made today feel, weak relative. But I mean, if we were talking 4,400 gold 18 months ago, people said, wow, that's really aggressive. That's a pretty big rally that you had. My family's was on 47th Street and Fine Jeweler. And my dad, who's with me right now, complaining about, he didn't sell all the remaining gold he had at 5,400. I'm like, did you ever think you could sell 4,400? And,
yeah.
And I think in those environments, it's never going to be a perfect hedge. There's no, if you want to own, perfect hedges, you can have break evens on the short end of the curve or 1 year tips, and you'll capture a lot of that inflation accrual. Outside of that, everything else is going to have its own path and destination. But if I take a step back and say what drove gold was the global fragmentation, which was a key part of our secular outlook. And if you look at the World Gold Council, they did a survey of central bank intentions, and the highest in history of respondents said that they intend to continue to accumulate gold reserves. So I think there is still a tremendous impetus. Maybe some of the memification and some of the short-term exuberance has been cooled, which I think is just really healthy for the market. So I think in general, the story behind gold is still very much intact. But yes, if the statements only show you year to date, it's down 10%, and we had more inflation.
No, it's a good reminder. I mean, and I'm a little embarrassed that I fell victim to the short-termism, that drives so many bad decisions. But again, that's why I like talking to you, Greg, because you really don't tend to live in the last 30 days. You take a more expansive view. What do you, I think a lot of what we talked about today sort of underscores sort of a structural position for commodities in portfolios, but also highlights the volatility that's possible in your space, especially at a time when we're running light inventories and we've got such sort of unprecedented demand coming through in different areas. So for advisors listening, what counsel would you give them on how to use commodities to create good results for their clients right now?
Sure. I look back and I say, do we have an out of sample period where commodities performed how they were supposed to for portfolios? The research I wrote at Goldman Sachs Commodity Research Group back in the early 2000s would have said that during this period of high inflation and highly volatile inflation, commodities play incredibly important roles in portfolio. The last decade, the BCOM, which is the hallmark index, is up 10%. Gold is up 15.5%. While gold hasn't perfectly in time with inflation, commodities have. And it's been the one liquid real asset that those who were invested in had the ability to use as an offensive tool to rebalance their portfolio, buy what's out of favor, meet capital calls. Real estate didn't do that. Infrastructure didn't do that. The illiquidity in those are ill-suited for being able to rebalance portfolios in any short-term horizon, and particularly they trade with long duration, which commodities don't do. So I think from that standpoint, we've had a textbook. We've gotten inflation, we've gotten good commodity returns, and they've been lowly correlated. So this over the course of this decade, gold and BCOM separately have been about correlated to the S&P by about 0.15. Hard to find another asset class out there that has that low of correlation over this period of time. And I think that really speaks to the attributes of the asset class. Now, the other thing to say is that commodities right now, the standard index, has a positive carry at about 5% right now. So if you're looking at like your inflation hedge, it's got a positive carry.
Yeah.
So if the vol normalizes back to like 15 to 18%, you're looking at, a third of your annual vol in terms of positive carry in the index.
Right.
There's not often, like certainly in the decade before when interest rates were at zero, like commodity carry was negative when we were dealing with the surpluses. Now, at 5%, and it's been as high as 8 or 10% until the most recent sell-off. Like that's a very good starting point for an investor who wants diversification. And I think that's where commodities have demonstrated its capability to serve an investor well.
All right. Perfect. This is great. Greg, thanks for taking the time. Maybe we'll check in with you over the course of the balance of the year and see how things are working their way through. Obviously, I think, all hopeful for a resolution of hostilities, and then we'll see how the trade deals and the politics of it are worked out along the way. And we know that you and the team will be working hard to make sense of it every day and do your best for our clients. For advisors listening, if you enjoyed today's conversation, if you want to go a little deeper on any of these topics, would really encourage you to visit us at PIMCO.com in the United States or your country's local website. If you identify yourself as a financial advisor, you'll be taken to Advisor Forum. That's our one-stop shop for you to find whatever you need from PIMCO to get studied up on the topics that interest you, prepare for your next big client meeting. We'll try and get that information for you quickly and practically so that you can read it between meetings as you go around to help your clients make sense of a volatile world. Please don't be shy. Hit like, hit subscribe. Let us know you're out there. It helps us keep bringing content like this to you. And we will be back in front of you with another podcast in the next couple of weeks. Thanks so much for listening. Greg, thanks again.
Thanks for the time, and I hope everyone has a happy summer and is enjoying the World Cup.
Excellent. All right. See ya.
The discussion and content provided within this podcast is intended for informational purposes only and may not be appropriate for all investors. Reliance upon information provided in a podcast is at the sole responsibility of the listener. The information included herein is not based on any particularized financial situation or need and is not intended to be and should not be construed as a forecast, research, investment advice, or a recommendation for any specific PIMCO or other security, strategy, product, or service. Past performance is not a guarantee of future results. All investments contain risk and may lose value. Investors should speak to their financial advisors regarding the investment mix that may be right for them based on their financial situation and investment objective. Podcasts may involve discussions with non-PIMCO personnel, and such content contain the current opinions of the speaker, but not necessarily those of PIMCO. Other podcasts may consist of audio recording of an existing PIMCO article, and such material contains the current opinions of the manager. The opinions expressed in all podcasts are subject to change without notice. Information contained herein has been obtained from sources believed to be reliable, but not guaranteed. PIMCO, as a general matter, provides services to qualified institutions, financial intermediaries, and institutional investors. This is not an offer to any person in any jurisdiction where unlawful or unauthorized. For additional important information, go to www.pimco.com/gbl/en/general/legal pages/podcast disclosures